Hey, welcome back to Everyday Economics. This is the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording this episode on Thursday, December 26th. And joining me as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, it's a holiday week, and we're slotting in some episodes of Everyday Economics. Your column, of course, will be out Monday at the Center Square. And each week you look at the things that are either upcoming or that were so incredibly important the week before that we need to talk about them a little bit more. What do you have on your agenda this week?
Well, we're going to get a update on home values from the Case-Shiller Home Price Index. Home values tend to decrease during the summer and winter months, summer, the fall essentially, and so we're going to end the year with home values decreasing slightly, but still up on a year-over-year basis. And then home buyers and sellers return in January, and I think they tend to return early spring, but I think this year we're probably going to get a big return, a strong return of home buyers and sellers at the start of the year. Well, for a couple of reasons. I think people are starting to believe that the mortgage rates will be higher in the spring. And if they believe mortgage rates will be higher, people who have been delayed moving will likely make that moving decision a little bit earlier. They would essentially rush out to try to make that moving decision happen sooner before an increase in mortgage. I am of the thought that potentially would actually have mortgage rates easing later in 2025, and so the recent increase in mortgage rates is probably not going to be sustained.
Okay. So on the calendar coming up next week, we're going to get pending home sales will come out on Monday. We'll know about that then. The Case-Shiller home price index.
I think that's going to be pretty strong.
Okay. Talk to me about that.
Yeah, it's similar thought. I think as people begin, you look at a consumer sentiment index, and people are okay right now because the economy is doing well, but they're starting to worry about business conditions, starting to worry about interest rates, going forward, right? I think the expectations were kind of the downside in the consumer sentiment survey, the Conference Board's consumer sentiment survey last week. And I think we're going to see that demonstrated through, the fact that if people believe interest rates will increase in the future, interest rates or even prices will increase in the future. They'll rush out and make their moving decisions, their buying decisions today as opposed to tomorrow. And so I expect to see, we had existing home sales beat expectations in November, right? Last month, very strong existing home sales report, and I think that we'll see the next report showing pending home sales also increasing more than expected, because I think that's what people are doing. They're taking advantage. A lot of people had been waiting on the wings for the opportunity to buy. Inventory is up almost 18% year over year. I think it's 17%, maybe something like that year over year. So buyers have more options out there. And if people have been waiting to move, they think prices are increasing or interest rates will be increasing in the spring, they'll likely try to make a move sooner rather than later. And I think that's really what we're going to see, especially in January, early in the season. We're probably going to see a big rebound in activity. Of course, mortgage rates will be the big factor, right? So if I can afford it, I move now, secure a mortgage rate, think about refinancing later. If I can't afford it, then I'm stuck. I'm waiting. I'm still waiting for mortgage rates to come down. I really think we're going to see mortgage rates ease further. Why? Because like I said previously, I think markets tend to overreact. They overreacted to the Fed speak. but ultimately the Fed will likely lower interest rates more than expected if the labor market cools just a little bit, right? This is a Fed that's got a bias. It's it's going to cut faster if labor conditions deteriorate, whereas it's willing to tolerate slightly higher inflation. So that's next week on the housing front. Of course, Happy New Year, guys! It's the New Year's Day. We're gonna get New Year's Eve, New Year's Day. And then we get construction spending. Construction spending's been pretty strong. Pretty strong on the back end of 2024. We'll get the ISM manufacturing survey as well. Manufacturing sector still in that contraction, in contraction territory. So you really have a manufacturing and goods sector that is still reeling ever since the Fed began raising interest rates.
Let's talk about rates a little bit. I mean, the initial reaction to Jay Powell's quarter point cut was that mortgage rates went up. They then bounced back down. I mean, I literally just checked in on it today, and maybe I'm looking at old data, but it seems like we're still under 7 at this point.
Yeah, I mean, last time I checked, what I try to do is check Mortgage News Daily, and Mortgage News Daily is a little bit more up to date.
Okay.
If you want to have like weekly rates, daily rates, you check out mortgagenewsdaily.com, which I really love that website. It keeps me up to date on everything that's happening. They also report, of course, the Freddie Mac 30-year fixed as well. But at Mortgage News Daily, we're at about 7.1, right? 7.1%. And so a lot of people worry that, hey, that's high. But look, the reality, guys, is that earlier this year, back in April, we touched 7.52, right? We went from 7.52, we're down to 7.1. Yes, things had come down a lot. Mortgage rates had come down 6 to 6.1% in September. So we're about a point higher than we were at the lows this year. Okay. But we're still lower than we were in the spring. We're still lower than the 7.52% reported in April 25th, 2024. So it's been great. We got a little break in September. Things are not as good as they were in September. But again, rates increased during that slow time of the year, that typically slow time of the year, and yet sales surprised on the upside, right? So again, and I'm only saying that for the people who are saying, well, the housing market could be crashing, not enough demand. Look, there's a ton of housing demand out there. There are still massive shortages. People are just waiting in the wings, doubling up with non-relatives for their opportunity to get a unit of their own. And when rates drop just a little bit, we see a surge in activity, and people go out and try to get that house, right? Builders have been helping because they're building smaller units, slightly less expensive, more affordable units to help people, and they're giving rate buy downs and all types of incentives to help people where it counts the most, which is basically in their wallet.
Right. All right, appreciate your thoughts as always. We'll call it good there. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.